Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome to another episode of Equity Mates, a podcast where we explore what is possible in the world of investing. If you've just joined us for the first time, a huge welcome. Welcome to the Equity Mates community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. We are going to start by talking about the news and talk about the Aussie dollar. Don't turn off your podcast. It can be interesting. But then, now this is interesting. Then we're going to be rejoined by Mr. Beatup himself, a new character in the Equity Mates world who has made a splash looking at beaten up stocks that are poised for a turnaround. Last time he came on, he talked to us about Tesla and what it's up about 40% from there. So
you've just stolen his thunder.
Big shoes to fill. Well, no. This is the tease to keep people around after the currency segment. And then we're going to be closing it out with a community question on investing for kids.
All right, well, let's get into it.
News and markets.
Now, we want to start with the Aussie dollar.
Yes, this is in the news, and not so much in the news now, although it's being spoken about, but it is going to be big news in the second half of the year, and it's going to rip.
Headline news?
AFR headline news.
It's going to rip. What do you mean by that?
So currencies are priced against each other, or you can price the currency against a basket. But generally, if you're pricing the Aussie dollar, you're generally looking at it compared to the US dollar. And generally, it trades in a range of between 60 and 70 cents. One Aussie dollar buys that amount of US cents. And the Aussie dollar's been pretty weak. It's been at the lower end of that band in the low 60s. The reason for that is the US raised rates more aggressively, and it meant investors could get a better rate of return over in the US than in Australia. So people got out of Australia, got into the US. But it looks like the US and Europe are going to cut interest rates. They've both got their respective measures of inflation back into the twos.
Full credit.
There's a US election coming up, and some may argue that there's a political incentive to cut in the next few months as well. Whereas Australia, we do not have inflation under control. The latest inflation reading was 4.1% for the 12 months. And so it's looking more and more likely that we are going to have an interest rate rise. Currencies are often driven by interest rate differentials. So it seems likely that the Aussie dollar is going to rise relative to the US.
I think it hit its lowest point versus the US dollar when I was in Europe, which was...
That's annoying for you?
Very annoying. Very annoying. So it's currently buying about 67 US cents, which is the highest level since January. Expectations, currency traders, those in the know, think that it could hit about 70 cents, so the top end of that average band, somewhere towards the second half of, this year.
Yeah. Now, we don't normally talk about currencies here, and the reason is it's normally not too important for our investing process. But there's going to be more headlines about it in the second half of the year. It's going to be front of mind. People are going to be asking, what should we do about it? So we thought we'd jump out ahead of it. So let's talk about who it's good for, who it's bad for, how you should think about the Aussie dollar being stronger, and then talk about how we're going to manage our investments on the back of it. So who it's good for. Australian consumers, to start with. We're a nation that don't manufacture a lot ourselves anymore. We import most of what we consume, except for food. So if we're buying stuff, chances are it's from overseas, and chances are our dollars can buy more of it.
Love that.
That's good.
That is great.
Honestly, kind of deflationary as well.
True. Yeah. On the flip side, though, it's bad for Aussie exporters. So for those businesses that are selling their goods and services to countries overseas, it becomes more expensive for their customers to actually buy their products. So not good news not great news if you're an Aussie exporter.
Yeah.
So a lot of our agriculture, mining,
Yeah.
Do you want me to keep listing?
Yeah,
exporting,
please.
tourism,
Yeah.
education.
Wine, that's agriculture, I guess. Education, yeah, that's a good one.
Anyway, the list goes on.
Another one that it's good for before we get to the investing side of it, Aussie travellers.
Yes.
If you are thinking of planning a trip towards the end of the year, you might find it doesn't cost you as much in Aussie dollars.
Oh, that would be nice.
Yes.
Yes.
Yeah.
Also bad for those with investments overseas. So if we're investing on the US stock markets, if we're selling those and bringing it back into Aussie dollars,
Yes.
not great.
Yeah, you started with the bad news, but it is also good news. It's good for people who want to buy more. Like if you want to buy an American stock, the same amount of Aussie dollars can buy more of that company because the currency is stronger.
Yes.
Yeah. So there's some of the, I guess, like the economics 101 effects of the Aussie dollar ripping. The final question is, how are we going to manage it?
Yeah. So for me personally, it makes absolutely no difference to my investing strategy. I am going traveling.
Where are you going?
Bali.
Yeah, okay.
Bali. So that would be helpful, I guess.
Can we please clip Bryce saying Bali that way and put it on socials?
It's because I messaged my wife the other day and for some reason it auto-corrected to B-A-L-E.
Oh,
and
Bale.
so, yeah, so my wife thought I was being like bougie, being like Bale. Anyway, it change what I'm doing from an investing point of view. Obviously, I buy stocks overseas, so I will be, I guess, reap the rewards and the benefits, but it won't change. It won't change my strategy at all.
For me, if it gets crazy, like if it's like above 70 US cents, if it's like 75 US cents, then it makes sense, I think, to like deviate from your strategy and put more into the US, like be opportunistic then, because you should get a currency free kick as the Aussie dollar trades back into the historical band. But yeah, I'm the same. Not really going to change my investment strategy much, but if I was going to be traveling soon, I would be loading up the Wise account as the currency got stronger with whatever foreign currency I was going to be using.
Nice. Well, we still need it actually to happen for it to really start ripping. Like we need rates to go up.
I think the news story is it has started happening.
In expectation.
We're at 67 US cents. That's the highest level since January. Like the uptick has started.
Yeah. But for it to hit 75 or something like.
It's actually 75 isn't actually that crazy. Last time it hit it was March 2022. We last hit parity in 2011.
Yeah, when I was at uni.
Yeah.
I remember that.
Yeah, so that's
good.
when one Aussie dollar bought one US dollar. And if we had loaded up on the big tech stocks then...
Oof. I think I went to the States instead, which was really helpful.
Yeah. Well, in 2002, we hit 50 cents as well. So that would have hurt. That would be seriously inflationary as well. Another conversation. Let's leave it there.
Let's wrap it there. All right, Ren. Well, it's time for Mr. Beatup. This is a new segment. If you've just joined us for the first time, we are joined by Mr. Beatup himself, Simon. Simon, welcome.
Good morning. Great to be back.
Mr. Beatup.
Mr. Beatup.
I have the beat that describes that moment accurately.
Simon is actually a colleague of ours here at Equity Mates, but has a knack for picking stocks where the market has overreacted to news.
Yes.
And that is the purpose of this segment. Simon will come in to give us an update on some stocks that have been beaten up but are certainly not down and out.
Yeah. Now, last time you came in and spoke about Tesla, Simon, it started the year at about 240, a bit over that, and it was down to about 180. People were worried. Was it going to miss deliveries? Was it all smoke and mirrors? Too much competition from China? What's happened since you came on the pod and spoke about it?
Well, it's done well. It's up 40% roughly, so it's now about $250. So yeah, the sentiment's changed. They've erased this year's losses. They're suddenly hitting delivery targets. People are getting optimistic again. So I've set expectations for this one. Got off to a good start.
Big expectations. Now, we should say that the purpose of this segment is not a buy, hold, or sell. It is just to, bring to light how silly the market can be sometimes.
Yeah, the market overreacts so much, and we often miss the overreaction, and then we're like, damn it. We, like Meta in 2022 is that classic example of the overreaction that was just glaringly obvious. Luckily for Simon and I, we did get on it. Bryce didn't follow us on.
No.
But, like Woolworths recently, and Simon, I might be stealing future Mr. Beatup segments, but, sentiment changed about Woolworths and the market punished it. But did anything change about Australia's largest grocery business in a pretty cozy duopoly? Like, I think there's so many opportunities to be... I was about to say so many opportunities to be opportunistic. But that's what this segment's all about.
Absolutely.
So, Simon, what are some of the things, I guess, that you're keeping an eye out for when you're looking for a Mr. Beatup stock?
Yeah, so I think it's exactly that. It's an overreaction. I guess fundamentally, the stock needs to be down significantly, ideally 30 to 50% plus from its all-time highs. Negative media attention, maybe some leadership issues, maybe they made some investment mistakes or change in strategy, and also if they're actually missing results. So I guess crucially though, it's the market has overreacted to these short-term problems, but the stock price doesn't necessarily accurately reflect the long-term health of the business.
Yeah. So you're not bringing companies here that are down that are going to continue to be down.
Hopefully not.
Hopefully not. Hopefully not.
That's Simon's challenge.
Yeah.
So we had a groundswell from the Equity Mates community. We put the call out, what a beaten up stock should Simon take a look at? And some notable ones, Carnival Cruise from Danny. Lucas suggested Ordinate. Mick suggested Block. So Simo, I guess, are any of those companies the ones that we're going to be talking about today?
Thanks for all those suggestions. They've definitely gone to the watch list, but I've got a different stock today. It's definitely hitting a lot of those criteria I mentioned, and that is Nike.
Okay. So,
is it Nike or Nike?
Oh, probably if you're American, Nike.
All right. Anyway, that's not the reason we're talking about it today. Now, for people watching on YouTube, you'll see that Simon has come dressed in costume, wearing his Nike shirt. So where do we want to start? Let's start with the bad news with Nike, where the sentiment is and why it's come across your radar.
Yeah, this really grabbed my attention just over a week ago. The stock got smashed. So it went down 20% in one day, which is actually its worst trading day since it IPO'd in 1980.
wow.
Yeah.
So it got beaten up. and basically this is on the back of, it had a quarterly update and it reported its slowest annual sales growth in 14 years, if you exclude COVID. Basically, revenue's flatlined. They also put out a pretty soft outlook for the next financial year.
Yeah, that was the thing that grabbed headlines. They said their revenue would be down 10%.
Yeah, so they've said they expect sales next year to be mid to high single-digit decline.
Yeah.
And they're missing expectations. The plunge wiped out about 28 billion of their market cap. But one of the really big stories to come out of it is that they've actually been losing market share, particularly in running, to some of these new brands like Hoka and On.
Yeah, Asics have come back. It's just like, this is the running shoe company that missed the boom in run clubs and running. Like, it's just obviously they had their focus elsewhere on professional athletes and everything they're doing, but to miss this is shameful.
Yeah,
You got to keep your eye on the core.
I was about to say Phil
Profit
Knight
from the core.
Phil Knight would be turning in his grave, but I don't think Phil Knight is dead yet.
No, he's not.
He's not.
So,
Yeah.
Talking about Phil Knight, so these results, they've put a lot of pressure on the leadership. So the current CEO, he's a guy called John Danaher. He's ex-eBay, ex-PayPal. He's seen a bit more of a tech guy than a shoe dog. He's been in for about 4 years. Morgan Stanley have come out. They've called his leadership into question, and they've said Nike's losing credibility because of him. But Phil Knight, the shoe dog himself, he's actually come out and he says he's got unwavering confidence and full support in John Danaher.
Yeah, now for people who haven't followed the Nike story super closely, they've really embraced a direct-to-consumer strategy. They have tried to cut out a lot of the big shoe retailers, or at least make them less important in their business and sell direct. And I guess that's where the debate is. Is that strategy the right strategy?
Yeah, exactly. So I guess Donahoe come from this eBay, this kind of tech background. They've gone heavy into direct to consumer, which worked wonders during COVID, actually, and they doubled down on it because it was working. But now people are returning to stores, people are going into running groups, people are getting out socializing again. These other brands have kind of filled that gap where Nike hasn't been investing in wholesale partnerships and retailers. They've come in, and that's how they've got this market share off of Nike.
So the purpose of the segment is not to come in and say this company's busted and it's going to keep going that way. It's to say that you believe or that the market may have overreacted, and what are some of the reasons that potentially it might recover from here?
Yeah, definitely. So the stock's down 59% now from its all-time highs, but there's 3 areas I want to talk about: finances, competition, and the brand. So if we start with the finances, look, if you just read the media headlines, you'd think Nike is in big trouble. Like, it had terrible results. The headlines are saying they're finished, Nike are over.
No one is reporting that Nike is over.
Right. Maybe that's a bit of an exaggeration. But
It's done. Back it up.
It's so done.
well, I don't think it is, but the headlines are bad, okay? Let's actually look at what happened. So revenues were down 2% for the quarter. Over the year, they were actually flat, but they cut their cost of sales by 2% over the year. So that actually increased their gross profit, 3%. Earnings per share was actually up. In the quarter, their gross margin increased. The overheads, they've cut by 9% in the last quarter. And if you zoom out, they've now had 21 years of dividend growth, 21 consecutive years. And since 2015, over the last 10 years or so, the revenue's actually been growing at a compound annual growth rate of 5.9%. So I think that's far from terrible. I think it's been quite a big overreaction in the headlines. But I guess one thing is true in the short term: the consumers all over are feeling the pinch. So this is a consumer brand. People got less disposable income because of the effect of inflation and interest rates. So I think this is definitely having an effect, but that's not necessarily just Nike specific, but it's a risk.
Yeah.
All right. So then on to the second thing, which is competition. We talked earlier about Nike potentially missing out on this boom in running culture. Talked about how they've heavily invested in direct consumer, but the CEO, he's come out now and he's acknowledged this. He says they've underinvested in this area. They're now trying to repair their wholesale relationships, and they're going to be investing a lot more in there. So that's a tick. They've also fallen behind a bit on innovation to companies like Hoka, but they are going to launch a number of new products in line with the Olympics this year, which I'll come on to in a second. But I think the key point here is if you zoom out, so let's zoom out. Remember, Nike's been around for about 60 years. This is not their first rodeo, okay? You don't have to look too far back to see that Nike's been challenged time and time again by new brands, and so far it's always come up in top. So it was Reebok in the 90s. It was And One. They were the hottest shoe brand in the world in the 2000s. Under Armour, they're now down 88% against their all-time highs.
I do rate Under Armour though.
Why isn't Under Armour the Mr. Beatup stock?
Yeah,
It's not coming back.
I don't mind Under Armour for gym wear and stuff. Yeah. Allbirds. I never got into the hype, but that was all the hype 5 years ago.
Yeah.
They're now actually worth less than 75 million, which is 0.1% of what Nike is worth.
Yeah.
So,
Okay.
so Nike, basically what I'm trying to say is Nike's got a history of killing its competitors. As soon as these brands lose their mojo, it can go south pretty quick for these other consumer brands.
Like Nike's losing their mojo though.
Whoa. Are they? So let's go on to the brand.
Yeah.
So I didn't really appreciate how big Nike was until I started doing this research. So actually 3 times the size of Adidas, and the global brand is a beast. So Interbrand is a company who do these annual reports on brands. They value the brand at the 9th most valuable brand in the world. And you think about it, along with the McDonald's golden arches, the Apple logo, that Nike tick, that Nike swoosh, that is one of the most recognizable insignias on the planet. It's quite hard to not to underestimate how big this brand is. This really blew my mind. On Instagram, Nike has 305 million followers, which makes it the 11th most followed account and the most followed brand in the world. Do you know who the number one?
Ronaldo.
No, Messi. Wait, followed or most liked?
Yeah.
Okay.
So
What was the question?
So you're both
Yeah.
right here.
Okay.
Ren's got some trivia on the Messi.
Oh, do you want me to?
Yeah.
Okay, so the most liked photo, or the most liked post on Instagram is no longer that egg. It's Messi celebrating
World
the
Cup.
2022 World Cup.
Yeah. But yeah, Bryce, you're correct. The most followed account, Ronaldo, 633 million followers.
Yeah.
Guess who he's got a lifetime partnership with?
Nike.
The Saudi
Correct.
Arabian Football Club.
Correct. Nike have got the biggest global tie-ups, the biggest, most recognisable stars. They've got basketball, NFL, skateboarding, soccer, you name it. They've got the big names. So their ability to distribute the brand, remain cool, remain relevant, I think is a massive competitive advantage. And they're about to go on a huge spend. So they haven't given numbers, but they've said this Olympics will be the biggest marketing spend they've ever done to try and target that 1 billion people they expect to tune in. And this is when they're going to release a load of new products. So we talked about the innovation thing before. This includes Eliud Kipchoge,
Yeah.
first ever man to break the 2-hour marathon. He's going for his third gold in a row at the Olympics marathon, and he's going to be launching and wearing the brand new Nike Alpha Fly trainer. So all this to be said, I just think the Nike brand, it's not going anywhere anytime soon.
Nice.
Well, there you go, Mr. Beatup.
All right. Well, Simon, thank you for coming in and talking us through Nike. At time of recording, it's $73 flat, trading on a price to earnings of 19. So certainly beaten up, but can this Olympics turn it around? Can it recover its lost ground with retailers? That'll be one to watch.
Love it, Simo. I think for me, this is a better example of a Mr. Beat-up stock than Tesla. I think this is really a market overreaction. Well, potentially market overreaction, given a lot of the points you've put forward that surround the longer term zoom out perspective for Nike. But yeah, looking forward to seeing these flies on Eliud for the marathon. But yeah, anyway, we'll leave it there. Thank you, Simo.
Thank
and
you.
if you have a stock that you would like Mr. Beatup to have a look at, head to equitymates.com/contact or hit us up on our Instagram page and we'll add it to the watch list. But we're going to take a very quick break, and on the other side, we're answering a community question around what stocks and sectors to look at when investing for kids. We'll be right back. Welcome back to Equity Mates Investing.
Let's ask the community.
Hey, Equity Mate.
I just had a question.
Hey, Bryce, I've got a question.
Question answered.
This week's question comes from Troy Patterson, and Troy asks, guys, what are some long-term stocks and sectors for me to look at for my newborn's shares portfolio that he wants to start for him? So Ren, where do we want to start with this one?
Yes, so I think if you're thinking about a newborn's share portfolio and you're thinking about their 60 or 70 year time horizon,
Yes.
I would argue that it actually doesn't.
Gee, you'd be a rough dad not giving it to your kid until they're 70.
Well, I mean, okay, so if you're thinking about investing for them and giving it to them when they're an adult, so like a 20-year time horizon, or if you're thinking about it, setting them up for long-term, 60 years, I actually don't think it differs too much from someone in their 20s or 30s thinking about a 30-year, 40-year time horizon, because it's not, we talk about different assets being suitable for different time horizons. We talk about, in the very short term, sort of 1 year, you want to be invested in cash, high interest cash, nothing more. You blow it out to sort of 2 to 3 years, you start looking at your fixed income options. You go to 5 to 7 years, you start looking at stocks. It's not like there's an asset that's most suited for like a 20-year time horizon or a 50-year time horizon. We've covered all the assets at that point. And so the answer that we give is going to be pretty similar to an answer that we give for someone in their 20s thinking about investing for retirement, with a really important caveat that the risk is actually higher as you blow your time horizon out, just because there's more uncertainty and more things change. So for me, it's not like there's new assets and new opportunities for growth. It's actually, you want to build the portfolio to be more resilient because it's going to be tested more.
Yeah.
So that's probably my starting point.
So with that said, let's get into the nitty-gritty. The most obvious answer when you're thinking about what to put in a portfolio for a pretty extensive time horizon is index ETFs.
Yes.
We've spoken about it time and time again. We're talking low-cost, diversified, global index ETFs. Specifically, you've got the ASX 200, which is the market here in Australia. You'd be looking at the S&P 500, the market over in the US. You could make a portfolio of some of the major markets around the world, the FTSE, for example, or you could take those ETFs that are set up to give you global access in one hit. For example, the MSCI All World Index. I think it's 1,500 companies spread across all major indexes.
Now, why the index ETF is the obvious, but I would argue the right answer is also it's a product that is set up to be truly long-term. The way that it rebalances every quarter, you cut your losers, you add more of your winners, it means that it is a product that is, in theory, meant to last for an infinitely long time, just continually rebalancing every quarter. So the risk of the index going away is close to zero. Indexes have gone away historically, but we're talking like the Russian Revolution in 1917 shutting the stock market down. Like that's the kind of historical event that would have to happen. As long as the Australian stock market exists, the ASX 200 in theory should exist. So when we're thinking about, like being really resilient, an index is a product that is designed to be resilient and to move with the changing tides of the stock market. So that's why it makes sense from a growth perspective, but also from a resilience point of view if you're thinking really long term. So that's the obvious answer. Let's move to individual stocks because that's really, I think, where the question was directing. For me, don't worry about growth. And we'll get into that. But for me, if you're thinking about individual stocks for a very long time horizon for your newborn, moat becomes the name of the game. Sustainable, defendable, competitive advantage that means your business will be there in the future. Because my guess is more than half of the ASX 200 stocks won't be in the ASX 200 in 60 years. They'll go bankrupt, they'll get bought out, they'll just decline because they'll get disrupted. And to prove that out, I found the top 10 of the ASX from 1968.
Nice.
So that's 56 years ago. Tell me how many of these companies you recognize. Top of the list, the just undisputed king of Australian stock market returns, BHP.
Yeah, crazy that it's still there.
In 1968, it had a market cap of $3 million.
Wow.
Yeah.
Wow. Phenomenal.
But after that, North Broken Hill, Conzinc Rio Tinto, heard of it, Hammersley, MIM, Western Mining Corp, CSR, Myer, New Broken Hill Corp, Ampol.
Wow.
So some of those names are still familiar. BHP, Rio Tinto, Myer, Ampol. So, if you'd bought those companies, you'd be okay. But a lot of the other ones have been merged or will have gone out of business or things would have happened.
Yeah, you would have had to have bought, or if you'd even missed one of them, you're in a bit of trouble.
Yeah. I would be arguing if you're looking at the ASX 200 today, forget growth. Focus on resilience if you're thinking about a 60-year time horizon. I'm going to stick to this 60 years because if we're saying 20 years,
Same thing.
Yeah. Without wanting to give individual names, where I'd be erring is like a BHP, a Woolworths, maybe a Commonwealth Bank. Like for me, they're the ones that are going to be there.
They're not going anywhere.
Like even Telstra for me, Telstra might not be there in 60 years. Like
wow.
How we deliver phone and internet connectivity is going to radically change.
Yeah.
But how we buy groceries is probably going to change less.
Yeah.
Yeah.
Well, they might still be there, in my opinion, but they might be chronically underperforming.
Yeah.
Which is why the beauty of the index product, again, comes into play.
Yeah.
You don't have to choose the top 10 stocks that you think are going to be there in 60 years.
Yeah.
And the best ones that are going to perform over this next 60 years are going to be the ones that are at the top of the index.
Yeah. The index is just a better designed product for a super long time horizon. It is. And, if you had bought the ASX 200 in 1968, it didn't even exist then as an index, but if you had bought it then, you would have been better off unless you just nailed your stock picking.
Yeah, you have to be super active.
But what I said earlier was what you want to avoid is growth stocks. And because the thinking, there can be a little bit of a growth trap in some ways. It can be like, I'm thinking about a 30-year, 40-year, 50-year time horizon. So I can buy the growth stocks because they're going to do well. And you might be right, but the challenge is too many of them will fall off.
Yeah.
Like growth stocks just have a question of, are they truly viable long term?
Yeah.
And for every Apple and Microsoft that does become truly viable long term, there's a long list of quote unquote growth stocks that didn't make it into the long term viable category.
Yeah.
The ones that I'm thinking about today, you know, that I would be questioning what they would look like in 60 years, like Nvidia, Tesla. Like maybe they do it. Maybe they are sustainably profitable, but maybe they get disrupted.
But there's also a huge tier of growth stocks that are below those like mega caps that are probably even more likely to not be around than Nvidia and Tesla. Like those a lot of the SaaS businesses, ones that we don't really hear of that are churning out incredible revenue growth at the moment.
Snowflake,
But
Datadog, like all that stuff. Like where
are they in 60 years? Yeah.
I think we've made the individual stocks point. So let's turn to another category of assets that we'd probably avoid. Thematic ETFs.
Yeah, so thematic ETFs, again, I think you can fall into a similar trap thinking that over the long term, you know, hydrogen or battery and storage technology, it's going to play out. It's a huge long-term trend. But again, the companies within that, they're not built for resilience. They're built for taking opportunity with a thematic that is playing out in a much shorter time horizon.
Yeah.
And you have no idea where that thematic is going to be in 60 years. You're essentially taking a bet that the best performing thematic would be battery and lithium technology.
Yeah.
So
let's make the classic example of hydrogen. Like, I think it is a reasonable thesis to say that 60 years from now, the world will be consuming more hydrogen than it is today. But that shouldn't lead you to say, all right, well, I'm going to buy a hydrogen ETF for my child and things will be good, because like the cost to produce hydrogen, who is producing it, and are they in the hydrogen ETF? Like there's so much uncertainty that for me, the thematic ETFs are not the right product for that time horizon. They're the right product for like more tactical, closely watched investments.
yeah.
So our conclusion, that is a long way of saying a pretty boring answer, that if you're truly thinking long term, you want to minimize uncertainty, the product that is most certain to still be there are these index products because of the way they are designed. So the easy answer, in our opinion, may be the best answer, and that is start investing for your kid early and dollar cost average into index ETFs.
Love it. And if anyone asks us about what we should do with kids, we're going to clip this up and put it on YouTube and put it on our Instagram, and then we're just going to send the link to everyone. Because that's the crux of it.
Yeah.
If you have a question that you would like us to answer, head to equitymates.com/contact. If you're also really enjoying the show and you get a lot of value out of the content that we create, then we would really appreciate if you could leave a 5-star rating and a review on your podcast app now. It does help us get in front of new Equity Mates audience. But Ren, we'll leave it there. We'll pick it up next episode.
Sounds good.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.